Warren Buffett made more money last night than you will make in the next 30 years. He did not work for it. He did not wake up early for it. He did not take a single meeting, send a single email, or make a single trade. He slept. And while he slept, the system he spent 60 years building quietly added millions to his net worth, the same way it did the night before, and the night before that, and every night for the past 6 decades. This video is about that system, not the version they sell you in books, the real one. Here is something nobody in the financial industry will say out loud. The advice they give you: wake up at 5, optimize your morning, build multiple income streams, stay informed, trade actively, never stop moving, is not designed to make you wealthy. It is designed to make you feel like you are becoming wealthy. There is a difference, and that difference is worth understanding before you spend another decade running in the wrong direction. Warren Buffett has been the living refutation of that advice for 60 years. He drinks 5 Coca-Colas a day. He eats at McDonald's. He drives himself to the same office he has worked in for decades. He reads for 6 hours and makes perhaps 1 phone call. His calendar, one of the wealthiest men alive, looks like a retired school teacher's. Blocks of empty space. Long stretches of nothing. And he has compounded wealth at roughly 20% per year for 6 consecutive decades. Not because he worked harder, because he understood something that the entire financial media complex is structurally incentivized to hide from you. Wealth is not built by activity. It is built by patience applied to the right system. What follows is that system exactly as Buffett has applied it, and exactly why almost nobody else can bring themselves to do the same. By now, before we talk about what Buffett did, we need to talk about one number. 97, as in 97% of Warren Buffett's wealth was accumulated after his 50th birthday. Let that land for a moment. By 50, Buffett had already been investing seriously for 30 years. He had already studied under Benjamin Graham. He had already run investment partnerships, taken over Berkshire Hathaway, and built a reputation as one of the finest investors alive. 30 years of relentless work, relentless reading, relentless compounding, and 97% of his wealth had not yet appeared. Here is what that means in concrete terms. If Warren Buffett had retired at 60, which most people would consider a full and successful career, you would never have heard his name. He would have ended his working life with perhaps a few $100 million. Comfortable, impressive by any normal measure, completely unremarkable in the history of finance. The Buffett you know, the $100 billion Buffett, the Oracle of Omaha, the greatest investor who ever lived, exists entirely because of what happened after 60, because of the decades he let the machine keep running after most people would have stopped. This is not a story about investing skill. It is a story about time. And the question it forces you to ask is this: what machine are you building right now, and are you giving it enough time to become something extraordinary? Mom, stop for a second and think about what you imagine Warren Buffett doing at work. You probably picture something intense. Phone calls with executives, rapid analysis of balance sheets, high-stakes decisions made under pressure. The image of finance as a contact sport. Now here is what he actually does. He wakes up. He reads the newspaper. He goes to the office, where he reads financial filings, annual reports, and business publications for most of the morning. He might make 1 or 2 phone calls. He thinks. He waits. By early afternoon, he is often done. He has described his ideal day as one where he can sit and read without interruption. He has said that the most important thing he does, the thing that has produced more value than any trade, any acquisition, any negotiation, is think, not act. In a typical year, Berkshire Hathaway makes a small handful of significant moves. Not dozens, not hundreds. A handful. Buffett has compared his approach to a baseball player standing at the plate with no called strikes. He can watch pitch after pitch go by without penalty, waiting for the one he is certain about before he swings. Most investors cannot do this. The silence is unbearable. The inactivity feels irresponsible. The absence of motion reads emotionally as failure, even when the correct answer is to do nothing at all. Buffett does nothing magnificently. That is the skill. That is what 60 years of practice looks like. Most people assume wealth is destroyed by bad investments, by picking the wrong stock, by getting the timing wrong, by not knowing enough. Buffett disagrees. He has watched people destroy wealth for 6 decades, and in his observation, the three most common causes have almost nothing to do with intelligence or information. The first is the need to feel busy. Activity feels like progress. Inactivity feels like negligence. When markets move in either direction, the psychological pull to do something is almost overwhelming. To adjust, to protect, to capitalize, to respond. But every unnecessary transaction has a cost. Fees, taxes on realized gains, the bid-ask spread, and most importantly, every transaction is an opportunity to make a mistake. The investor who buys a great business and holds it for 40 years without touching it will, in most cases, dramatically outperform the investor who makes 12 intelligent-seeming decisions per year. Not because the first investor is smarter, because they made fewer opportunities for error. Buffett's rule is simple. The burden of proof is always on action, never on inaction. If you cannot articulate a compelling reason to sell, you do not sell. If you cannot articulate a compelling reason to buy, you do not buy. Silence is a valid position. The second is the need to be interesting. Nobody wants to say at a dinner party, "I bought a broad index fund 3 years ago and I have not looked at it since." It is not a story. It does not signal sophistication. It does not position you as someone who understands markets. It is profoundly, almost embarrassingly, unimpressive. Buffett calls this living on the outer scorecard, optimizing for how your decisions appear to others rather than what they actually produce. Corporations do the same thing. They make acquisitions not because the acquisitions will create value, but because they look bold and strategic. The willingness to be boring, to own ordinary-sounding things quietly for long periods of time is one of the rarest competitive advantages in investing. In a world full of people trying to look smart about money, the person content to actually be right, invisibly over decades, wins almost every time. The third is the need for certainty before acting. The future is uncertain. It always has been. No amount of analysis, no quantity of data, no expert opinion will ever make a future investment outcome certain. And yet most people wait for a clearer signal, a more obvious opportunity, a moment when the risk feels manageable. That moment does not come. It never comes. Buffett has said that if he waited to invest only when he felt certain, he would never have invested in anything. His solution is not to eliminate uncertainty but to price it. He buys businesses at a discount to what he believes they are worth, creating a margin of safety that protects him when he is wrong. He does not need to be right about everything. He needs to be right enough and never catastrophically wrong. Uncertainty is not the enemy of wealth. It is the condition under which wealth is created. If the future were clear, every good investment would already be priced accordingly, and no opportunity would exist. 3 steps. Deceptively simple. Almost impossible to follow. Step 1. Buy wonderful businesses at fair prices. Not cheap businesses. Not exciting businesses. Wonderful businesses meaning businesses with durable competitive advantages, honest and capable management, and economics that strengthen rather than erode over time. Buffett calls a competitive advantage a moat. It is the thing that protects a business from competition, a brand so strong that customers will not switch, a cost structure so efficient that competitors cannot undercut it, a network so embedded that leaving it is more trouble than it is worth. Coca-Cola has a moat. American Express has a moat. See's Candies has a moat. Most businesses do not have moat. Most businesses are fighting for every customer, every margin point, every year. These businesses can be good investments at the right price, but they are not the businesses that compound wealth across decades. Find the ones with moats. Pay a fair price. This alone puts you ahead of most investors. Step 2. Hold it for as long as the thesis is intact. Not until it goes up enough that you feel smart. Not until it goes down enough that you get scared. Until the fundamental reason you bought it, the moat, the management, the economics, is no longer true. Buffett has held Coca-Cola since 1988. He has held American Express since the 1960s. He did not sell when the market dropped. He did not sell when he had 100% gain. He did not sell when people told him the businesses were overvalued. He held because the thesis was intact. Most people cannot do this. The gain feels like money on the table. The loss feels like a warning. Both feelings are noise. The signal is, has the business changed? If not, hold. Step 3, do nothing. Between the buying and the holding, do nothing. Do not check the price every day. Do not adjust based on quarterly earnings. Do not react to news. Do not rebalance because some other opportunity looks more attractive. Let the machine run. This step sounds trivial. It is the hardest thing Buffett does. It is the thing that separates his results from almost every other investor alive. Be honest with yourself for one moment. You understood everything above. The logic is clear. The evidence is overwhelming. Compounding works. Patience wins. Activity destroys returns. You know this, and you are still going to check your portfolio tomorrow morning. Why? Not because you are irrational, because you are human. And the financial world is designed deliberately, structurally, profitably to exploit the most human parts of you. Every financial news channel needs you to believe that what happens today matters. Every trading platform is designed to make buying and selling feel exciting and consequential. Every market pundit needs to say something today, whether or not anything meaningful has changed. The entire infrastructure of modern finance is built on the premise that you should be doing something, because if you are doing nothing, they are not making money. Buffett opted out of this infrastructure entirely. He lives in Omaha, not New York. He does not appear on television to share his current views. He does not react to quarterly earnings reports. He has built a life structured around the one thing that actually works, long-term patience, and eliminated everything that creates pressure to abandon it. You do not need to move to Omaha, but you do need to understand what you are up against. The pressure to act is not coming from wisdom. It is coming from an industry that profits from your activity regardless of whether your activity benefits you. The laziest path to wealth requires the most deliberate protection of your attention, your time horizon, and your ability to sit still when everything around you is screaming to move. Buffett's system is not reserved for people with millions to invest. He has said explicitly and repeatedly that the average person with modest capital, limited time, and no financial expertise has access to a version of his approach that will outperform most professional investors over a long enough time horizon. Here is what that looks like in practice. Read before you invest. Not financial news, not stock tips. The fundamentals, how businesses create value, what competitive advantages look like and how they erode. The history of markets, not just the last 5 years, but the last 100. Buffett estimates he spent years building a knowledge base before he deployed serious capital. The knowledge compounds the same way money does. Skip this step and you are flying blind. Define your circle and stay inside it. You have knowledge about your industry, your customers, the businesses you interact with daily that most investors do not have. Use it, invest in businesses you genuinely understand, where you can form an independent view about their long-term competitive position. Outside that circle, own a broad index fund and let the market's collective knowledge do the work. Start now, not when you feel ready. $1 invested at 25 and left untouched for 40 years is worth dramatically more than $1 invested at 35 and left for 30 years. The difference is not strategy. It is 10 years of compounding that cannot be recovered. The best time to start was 10 years ago. The second best time is today. Protect your time horizon like it is your most valuable asset. Because it is. The single most destructive thing you can do to your financial future is shorten your time horizon by selling in a downturn, by trading frequently, by treating long-term investments like short-term bets. Every time you shorten the horizon, you interrupt the compounding. Every interruption costs more than it appears to. Then, and this is the hardest part, do nothing. Build the portfolio. Automate the contributions. Turn off the noise. Check in once a year if you must. Otherwise, let the machine run. Every night for the past 60 years, while Warren Buffett slept, his system ran. The businesses he owned opened their doors, served their customers, generated their earnings, and added to the value of what he held. He did not need to supervise it. He did not need to optimize it. He built the machine, pointed it in the right direction, and got out of the way. That is the full secret. Not a stock tip, not a formula. Not a morning routine or a productivity system or a 7-step framework. Build the right machine, point it forward, get out of the way, and give it more time than feels comfortable. The laziest path to wealth is not actually lazy. It requires more discipline than any hustle, more patience than any grind, and more courage than any trade. But it is the only path that has actually worked reliably, consistently across every decade and every market cycle for the people willing to walk it. Buffett walked it for 60 years. The machine ran every night he slept. The question is, when does yours start?